You're listening to the Financial Source podcast on YouTube.
So today we're doing a deep dive into the Japanese yen. And if you've been watching the currency markets, you know the USD-JPY rate is starting to look pretty wild again.
It really is. We're creeping back toward that 160 level.
A number that definitely makes officials in Tokyo nervous. And according to this new analysis we're looking at from MUFG Bank, a big part of the reason is, well, politics.
It's a really tough spot. We saw that quick dip, that correction down to 152, and I think everyone sort of took a breath.
Right, thinking the pressure was off.
Exactly. But it was incredibly short-lived. The yen is sliding again, and this time the catalyst seems to be coming right from the top.
That's what I wanted to ask about. The MUFG report points specifically to the February 8th election. But here's the part I don't quite get. Prime Minister Sanaé Tacαΐτσι is, by all accounts, polling very well.
Yeah, her coalition looks strong.
So they're expected to win a solid majority. And usually, political stability is a good thing for a currency, isn't it? I mean, investors love stability.
They do, in a vacuum, yes. But the market is looking one step beyond that. It's looking at what she plans to do with that stability.
Aye.
A big win gives her a huge political mandate. And the expectation, and this is what the MUFG analysts are highlighting, is that she's going to use it to, well, open the wallet.
So we're talking about a big stimulus package.
We're talking about aggressive fiscal expansion. You know, Japan's got sluggish growth, they have rising defense needs, and the cost of living is really starting to bite.
So a big win gives her the green light to spend her way out of those problems.
Precisely.
Okay, so the government issues a ton of new debt to fund all this spending. Normally, that would push interest rates up, wouldn't it? You have to offer higher yield to attract bond buyers?
That is the standard mechanism, yes.
Yeah.
But this is the classic Japanese puzzle. You have the government hitting the fiscal gas pedal.
And the Bank of Japan.
The BOJ is basically pulling the handbrake. They are still incredibly cautious, very accommodative.
Because they refuse to raise their interest rates.
They're keeping short-term rates pinned right near zero. So even if the market wants to push long-term bond yields higher because of all this new debt, the BOJ is always there in the market, effectively capping how high they can go.
And that disconnect must drive capital out of the country.
It drives capital right out of the yen. Think about it. You've got the U.S. Federal Reserve with rates significantly higher. Japan is near zero. If you're an investor, where are you putting your money?
You're putting it where it earns a decent yield.
Yeah.
You sell yen, you buy dollars.
And that's the carry trade. It becomes almost a one-way bet. The more Tacăici's government looks set to spend without the BOJ budging on rates, the wider that gap feels, and the more incentive there is to sell yen.
So it's this strange trap then. The stronger the prime minister's political position becomes, the more she's expected to spend.
And the weaker the currency gets. It's a real irony.
Which explains why the MUFG team says any rallies in the yen will probably be, I think the word they used was shallow.
Exactly. You might see these small bounces, but the underlying, the macro fundamentals are all pointing down for the currency.
So what happens when government officials get on the news and say they're watching the currency closely with a sense of urgency? Does the market even listen anymore?
Not really. That's what we call verbal intervention, and it has diminishing returns. You can talk a big game, but if your fiscal policy is spend more and your monetary policy is keep rates at zero,
A market can do the math.
the market does the math. The fundamentals are screaming weak yen no matter what officials say.
So for anyone listening and trying to connect these dots, it leaves the yen in a pretty tough spot.
It's very vulnerable. As long as this dynamic holds a strong political mandate for spending combined with a very dovish central bank, the path of least resistance for the currency is down.
It really does feel like a game of chicken is brewing between the currency market and the Bank of Japan.
It is. Which leaves us with a final thought to chew on. If this setup continues, with fiscal policy getting looser and monetary policy staying tight, does the market eventually force the BOJ's hand? Or does the currency just have to absorb all of that pressure until something finally breaks?
A massive question for the markets heading into February. Thanks for breaking that down for us. We will see you on the next deep dive.